Number 1. The head and shoulders. 3 peaks, a shoulder, a higher head, and a lower shoulder, with one line connecting the lows between them called the neckline. This is the most famous reversal pattern in trading, and here's why it works. Each push higher is weaker than the last. The head makes a new high, but the second shoulder can't even match it. The buyers are done. The moment price closes below the neckline, the uptrend is officially broken. That's your entry, short the break. Your target, measure the height from the head down to the neckline and project it below. Head at 60, neckline at 50. That's $10, so you're aiming for 40. Stop loss just above the second shoulder. Simple, clean, and it's been ending uptrends for over 100 years. Number 2, the double top. Price rallies to a high, pulls back, rallies again to the same level, and gets rejected. Twice. 2 peaks, same price, and between them, a dip called the valley. The logic couldn't be simpler. The market tried the same door 2 times, and it was locked both times. Buyers who miss the first rejection get a second chance to see it fail, and when they give up, price falls hard. Your entry, when price closes below the valley low. Your target, take the height from the peaks down to the valley and project it lower. Peaks at 50, valley at 44, $6 of height, so you target 38. Stop loss just above the valley, safely under those 2 peaks. If price climbs back over the peaks, you're out. The pattern's dead. Number 3, the bullish flag. A strong near vertical rally, that's the flagpole. Then a small tight pullback drifting slightly down in a neat little channel. That's the flag. This one is not a reversal, it's a continuation. That drift isn't selling pressure, it's just the market catching its breath. Early buyers take profit, new buyers step in, and the trend resumes. The tighter and calmer the flag, the better. Your entry, when price breaks up and out of the flag channel. Your target, measure the entire flagpole, say it ran from 40 to 50, $10, and project that same distance from the bottom of the flag. Stop loss just below the flag's lowest point. Flags are one of the highest probability patterns in a trending market. Momentum rarely dies in one push. Number 4, the ascending triangle. A flat ceiling on top, resistance hit again and again at the same price, and a rising floor underneath, each low higher than the last. Buyers are getting stronger with every dip, stepping in earlier each time, while sellers defend one single level. That's pressure building against the wall, and eventually the wall breaks. This is one of the most reliably bullish shapes on a chart. Your entry, a candle closing above the flat resistance line. Look for a volume spike on the break. That's real buying, not a fake out. Your target, measure the height of the triangle at its widest part, the back, and add it to the breakout level. Resistance at 55, widest point $5. Target 60. Stop loss below the most recent higher low. Number 5, the ascending staircase. This one is the simplest of them all and the most underrated. Price climbs, pauses sideways, climbs again, pauses again, up, flat, like steps on a staircase. Each pause is a little shelf where the market rests, and each shelf becomes support for the next move up. This is what a healthy uptrend actually looks like. Not a straight line, but steps. How to trade it? Buy the breakout from each shelf as a new step begins, or buy the dip when price returns to the top of the previous step and holds. Your stop goes below the last step, because the moment the step breaks and price falls through the previous shelf, the staircase is over. Ride it step by step and move your stop up behind each new one, trend following at its cleanest. Number 6, the symmetrical triangle. Lower highs from above, higher lows from below, 2 trend lines squeezing toward a point, with price coiling tighter and tighter in between. Unlike the ascending triangle, neither side is winning here. Buyers and sellers are in a dead heat. Volume dries up and the market compresses like a spring. Then it snaps. Here's the honest part. A symmetrical triangle doesn't tell you the direction in advance. It usually breaks in the direction of the trend that came before it, but you never assume. You wait. Your entry: a strong candle closing outside either line. Trade the side that breaks. Your target: the height of the triangle at its widest, projected from the breakout. Stop loss just inside the opposite side of the triangle. Let the market pick the direction, then follow it. Number 7. The rising wedge. Price is climbing, higher highs, higher lows, so it looks bullish. But look closer, the lows are rising faster than the highs. The two lines are converging, the channel is tightening, and every push-up gains less ground than the one before. That's not strength, that's buying running out of fuel, dressed up as an uptrend. When the last buyers are exhausted, price breaks down through the lower line, and the fall is usually sharp. Your entry: a candle closing below that lower rising line. Your target: the height of the wedge at its widest part, projected down from the break. Stop loss just above the last high inside the wedge. Remember the rule: a rising wedge breaks down, and its mirror, the falling wedge, breaks up. The wedge points one way, price goes the other. Number 8. The cup and handle. A long rounded bowl, price drifts down, curves along the bottom, and climbs back up to the old high. That's the cup. Then, right at the rim, a small dip. Sellers from the old high take one last shot. That's the handle, and it's the whole secret. That little dip shakes out the weak hands, so when price pushes through the rim, there's nobody left to sell. Your entry: a candle closing above the rim, the top of the cup. Volume should surge on the break. Your target: measure the depth of the cup, rim at 50, bottom at 40, $10, and add it to the rim. Target: 60. Stop loss below the handle's low, never the cup's bottom. The handle is shallow, so your risk stays small while the upside stays big. And number 9, the rectangle breakout. Two flat horizontal lines, resistance on top, support below, and price bouncing between them like a ball in a box, sideways again and again. Most traders get bored here and walk away. That's the mistake. A rectangle means the market is loading up, not shutting down, and the longer it stays boxed in, the bigger the move when it escapes. Your entry: a decisive candle closing outside the box, usually in the direction of the trend that came before it. Your target: the height of the box, projected from the breakout. Box between 50 and 55, that's $5. So an upside break targets 60. Stop loss back inside the box, just past the broken line. If price falls back into the rectangle, the breakout failed, you're out. So those are the 9. The most common patterns you'll see on any chart, on any time frame. Every single one is an edge, a story about buyers and sellers with an entry, a target, and a stop. Wait for the break, define your risk, and let the trade come to you. If you want any of these explained in depth, step by step, check the full lessons on the channel. I'll see you in the next one.